Hey everyone, welcome back to Corporate Decoder. Today FUSE just filed its quarterly report, and I am seeing a lot of red flags that matter. Quick note, this is not financial advice, just my take on public filings for educational purposes. Fusemachines is burning through cash and struggling to hit revenue targets, while still trying to manage a complicated financial situation. Fusemachines Incorporated, a company that provides artificial intelligence solutions and services, has just released its quarterly report for the period ending the 30th of June 2026. This filing gives us a peek into how the company is doing financially. Let's start with the balance sheet, which is like a snapshot of what the company owns and owes. As of the 30th of June 2026, Fusemachines had about $3.17 million in total assets. That might sound like a lot, but it is down significantly from $7.54 million at the end of 2025. Or what they owe were around $20.53 million. That means they owe a lot more than they own, which is a concerning sign. One of the most important numbers for any company is its cash. As of the 30th of June 2026, Fusemachines had only $368,000 in cash. This is a massive drop from $4.22 million just 6 months earlier. Companies need cash to operate, pay employees, and invest in their future. This low cash balance is a major warning sign. And here is another concerning figure. Their total stockholders deficit was almost $17.35 million. A deficit means the company owes more than it is worth, which is never a good sign for investors. Now, let's look at the income statement, which shows how much money the company made and lost. For the 3 months ending the 30th of June 2026, Fusemachines brought in $1.79 million in revenue, but they lost $2.85 million. That means they spent a lot more than they earned. This revenue is also down from the same period last year when they made $2.03 million. So not only are they losing money, they're also making less money than before. For the 6 months ending the 30th of June 2026, the revenue was $3.67 million, but the net loss was even bigger at $3.72 million. Again, this is less revenue than the $3.99 million they made in the first 6 months of 2025, and they are losing more money. Interestingly, the number of shares outstanding has jumped significantly from about 7.27 million in 2025 to nearly 29 million in 2026. When a company loses money and its share count goes up, it means each shareholder owns a smaller piece of a company that is not doing well, leading to a much lower net loss per S-share. For instance, the net loss per S-share went from negative 52 cents to negative 10 cents. A big reason for the increased expenses seems to be stock-based compensation. For the 6 months ending the 30th of June 2026, this cost $107,000, which is a significant jump from $118,000 in the same period last year. And there is more restricted stock unit expenses, which are a form of employee compensation, shot up dramatically from zero in the first half of 2025 to $771,000 in the first half of 2026. This heavily impacts their general and administrative costs, making them balloon by 79%. These general and administrative expenses went from $3.5 million in the first half of 2025 to a staggering $6.25 million in the first half of 2026. That is a huge increase, driven by those stock-based compensation expenses and higher professional service costs. Fusemachines also has a significant forward purchase derivative liability, which was over $8 million as of the 30th of June 2026. This is a complex financial instrument and its value has been fluctuating. It is a big chunk of their current liabilities. They also have shortfall warrants, which are basically options for investors to buy more shares at a certain price. The exercise price of these warrants was recently reduced, which could lead to more dilution for existing shareholders. Now, let's talk about NASDAQ compliance. The company has had a rough time meeting NASDAQ's requirements for stock price and market value. They've received multiple warnings about not meeting the minimum market value of publicly held shares. If they can't fix this by January 2027, their stock could be delisted. This is similar to what happened to companies like Radio Shack or Sears in their later years, and it often leads to a significant drop in stock value and makes it much harder to raise money. Losing that NASDAQ listing can make a small company's stock price drop by as much as 70 to 90%. Looking ahead, Fusemachines recently announced a financing deal with Meteora and other investors, raising about $2 million by issuing convertible notes and warrants. While this brings in much needed cash, convertible notes can be converted into stock, which dilutes existing shareholders. And the fact that they have to register these shares for resale within 30 days, and the potential for that to be a default if not done on time. adds another layer of risk. It is a common strategy for struggling companies, but it often leads to more dilution down the road. And here is the most serious warning. The company itself acknowledges that there is substantial doubt regarding the company's ability to continue as a going concern within 1 year. This is a formal way of saying they might not be able to stay in business. They've burned through most of their cash, are losing money, and need to raise more capital just to keep the lights on. This is a situation similar to companies like Bed Bath and Beyond or Rite Aid, which eventually faced bankruptcy. They've entered into an agreement with Roth Principal Investments for up to $20 million in equity financing, but there is no guarantee they'll get all of it, or that it will be enough. This kind of financing can be very dilutive, meaning existing shareholders will own a much smaller piece of the company. Their cash flow statement shows they used $3.51 million in cash for operations in the first half of 2026. That is a huge increase from just $149,000 used in the same period of 2025. This means they're spending money much faster than they're bringing it in from their actual business operations. So, what is the verdict on Fusemachines? The company is facing serious financial challenges. Revenue is down, losses are up, cash is critically low, and they're heavily reliant on new financing, which could be very dilutive. The going concern warning is the biggest red flag, suggesting the company might not survive long term without significant changes or more funding. The risk I am watching is whether they can secure enough funding and turn around their operations before they run out of cash. The tools I use to analyze these filings are linked in the description below. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.